Good morning, Shrewd traders. This is Gary Ender with the Sunday Shrewd Special. Today we're going to take a look at SPY, and we'll also take a look at the sectors of the S&P 500 by way of ETFs. Here's the SPY, or the ETF for the S&P 500 we see over the last several days, and I can come in a little bit closer on this first. As you know, last week we had some pretty decent selling here. The lower high that we see right here, the high point of this last rally, happened on the 1st of this month. From that point, straight downhill. If I come out in this a little bit, you see I have the Fibonacci retracement set up, and I'm actually using this low. We can see that the 62% retracement is right in this support area, and we've got some upcoming support in the 2750 to 2825 area. Now when you use Fibonacci like this, there are times where you say, should I start it here or should I start it down here? Where did this run start? If we bring it down a little bit, we see that the 50% retracement is just above these other support areas. So we do have some support in here, and by the way of the Shrewd trading model, we are getting quite a bit oversold at this time. But remember, when we're oversold, we can continue to go down until we see price action that suggests that it wants to reverse at that time. So if we keep our Fibonacci retracement here, we see the 50% retracement, the 62% retracement. We see the other areas of support in here, and if we move it back up to where I originally had it, then we see the 62% retracement is right in this group of support. Now remember, just because we have support in this area does not mean that the market would want to reverse or stop this downtrend at this time. What it means is we want to watch the price action very closely as it gets down to these levels. The way that the trading model is set up right now means that if we do get a rally off of one of these support points, it's most likely going to set us up for additional selling after that rally. Oftentimes, when you have a downtrend in place, what you see is short covering rallies that are hard and fast, and they set up additional selling opportunities. But we'll come back to that after we do see some type of a rally. If I run down through the ETFs for the sectors, we see XLB on Friday. That also broke support. The next support down just below 32 here, and then 3140, the next support point below that. XLB is the materials sector. Obviously, the action of the dollar's been very strong. That's also going to have an impact on the materials sector. If we look at XLE sitting right at support here. We see the prior low, the swing low that we have in there. If I come out on this a little bit, we see that if we break this swing low, we don't have a lot of decent support below that. So this is a very important spot for XLE. XLF, the ETF for the financials, we see a potential support point down here around the 1350, 1360 area. We also have the 62% retracement right in this area, and just like with the S&P 500, if I move this Fibonacci retracement point down to the next level, we see that that lowers the 62% retracement, but it still gives us this area of confluence. And if it does decide that it wants to break below here, we have gap support in this area, and below the gap support we'll be looking all the way down to around the 12.25 area. The industrials sitting right on support here. Again, if I come out on this a little bit, we see the swing highs that we had in this area. We also have gap support in this area right about where it closed on Friday. If it decides it's going to start out bearishly on Monday, we'll be looking down around the 3220 area as the next decent support point. XLK, which is the technology sector. We also have gap support right where it closed on Friday. If it decides that it wants to start moving down below that point, 2665 is the next support level, and we do have a confluence of support down here around the 2610 to the 2665 area. Consumer staples is still holding up, has not broken support yet. We see the swing low here, the swing low here. Obviously, there are certain sectors that the money managers that have to be 100% invested or that want to try to hang out on the long side, they'll move into these different sectors and they hold up much better as the market is in a downtrend, and the consumer staples is one of those. We see it still holding support. If it does break this support level, we're down here around 3275 as the next decent support. The utilities also holding up here. We see if we put the Fibonacci retracement on this, we're at about the 38% retracement. We also have support just below that, around the 35.25 level. If it breaks below that, we see the 50, the 62% retracement, but again, holding up much better than other areas of the market that we're looking at. XLV, we also see this holding up much better, has not really broken through yet. If it does break through this support level, we have a couple points of gap support here. And the healthcare is another that typically holds up better when the market's in a downtrend. But you can see that if it heads below this line that we have drawn here, this white trend line that we have, the odds are that that could go much lower. Consumer discretionary, we see the gap support that we have here. That's also about the 50% retracement. The 50% retracement is just above this at about 41.80. So this is another market that's near a potential support level. Doesn't mean that it's going to stop going down, but the potential is there. So this is just a quick run through these different ETFs, the sectors that make up the S&P 500. This is Gary Ender. Hopefully this Shrewd Sunday special enhances your ability to maneuver in these markets early next week. Have a great weekend.